So if all you know after the first dividend, your expectation of the growth rate for 5 years, for years 2 through 5, calculate them that way, you're done, okay? 37.92. So let's get a good estimate of growth rate for Coke, or discount rate. This is something we haven't covered yet, so I'm going to use this. Beta of 0.60. 5%. 5 plus 0.60 times 4. 7.5 is a better number. We will talk about how to approximate or estimate that number basically in chapter 11. But for now, you're gonna trust me that 7.5 is not a bad number for Coke. So it's 75.98, okay? Coke is trading at, let's do this. Oh. That's an input. $54.08. So if that difference is negative, taking those discount rates and growth rates seriously, we're going to say that Coke is basically undervalued in the market. Okay? Now, we can ask an alternative question. What is the growth rate that's going to give us the market price, right? If I make that difference 0, data, what if, goal seek, make this difference 0 by changing the growth rate, second stage growth rate. That's an important number because it says how fast the company's dividends are going to grow after 5 years. This says 384. If you believe that number is too low, the company is undervalued. If you believe that number is too high, the company is overvalued. For example, let's apply the same thing to Pepsi. It has a beta of 0.58, so 7.5 is not bad. What did they pay? Dividends, $4.83. Their expected growth rates are 790 and 815. Let's do it from here. company's stock price is 160. And let's find the implied growth rate. Data, what if analysis, goal seek to 0 by changing the growth rate. 401. Again, taking that discount rate to be seriously, this basically says discount rate and growth rates for the first 5 years. The implied growth rate for the second stage is 4% for Pepsi, 384 for Coke. Now, you don't look for too much precision in these. That means Coke and Pepsi are pretty much valued at the same level. And 4% is not that bad. Implied, if you think about 2% overall US economy growth plus 2% inflation, 4% is a roughly appropriate number for long-term growth. Let's use a different firm, Apple. After this, we're going to take a break. It's $173. Dividend 96 cents. Growth rates are 820 and 698. If you make that difference 0. Did I do it correctly? Oh, Apple's cost of capital is going to be higher anyway. Let's look at the dividend. Yeah, 96 cents. And proper discount rate for Apple is probably 5% plus 1.31 times 4, 10 and a quarter. Let's just call it 10. We're going to figure out the growth rate that's going to give us the market price. It basically says for this market price to be justified, Apple should be growing at 9.5% until infinity. Now, that is not a credible number. If you think that overall economy is going to grow at 4 or 5% in nominal terms, Apple growing 10% until the end of time, that's not a credible number. That means Apple is overpriced relative to Coke and what you want to call Pepsi. Let's do one more. Let's see. Intel. They pay 50 cents. $0.89. 176.30 and 7. Oops. Again. Again, pretty high number. By the way, I wouldn't ever trade based on trade ideas you obtain this way, because this is, you can think of dividend growth model as only a teaching tool. There are better ways to do it. We talk about those in upper level finance classes, but for this class, we'll just do dividend growth model. Let's give a break. Let's get back here at 7:30. Then we're going to continue with chapter 7. Talk about structure of the stock markets, a little bit of corporate governance, and then we'll do a few problems from chapter 7. All right, let's continue, guys. Basically,